guest host for the hour. Good to have you with us. As always, love having our First Men and our Fridays with you.
Thank you.
So you're basically in the Pisani camp that provided we get good information, positive data points throughout the month of December, it's pretty good sailing from here till the end of the year at least.
Yeah, what's interesting now is, the market really started rallying when the data came in positively, when inflation was coming down, when earnings were going up. I mean, historically, the markets have discounted that before, and we'd be sitting there and the markets are going up and, rates were going up and wondering what was going on. But this time it was reactive to what's going on. So I think the market needs to be fed continually positive information, which means rates can't go up from here, which also means that if rates go down, it has to be for the right reason. It can't be because now the Fed, if Powell had said, well, rates are going to go down because we see a slowdown, you might have seen a very different reaction from the market, because then it's sell now, buy later, because we don't know what's really slowing down. The consumer, we know, is holding up, even though it is slowing. You're seeing that in some of the data for some of the retail stocks. That's 60% of our economy. So we are going there, but valuation is going to be really important, and rates are going to be really important. Employment's going to be really important. And also, we're also talking about a static world, and we know that's not going to happen. So if something happens geopolitically in the next day, few weeks, we were in a period of time where every Friday the market sold off just because we didn't know what was going to. So now that's been discounted too. So Bob's right. There's a lot of good information that's been discounted in the market, but we have to be careful because you do get some data points.
Do you think the Fed is almost most of the way to threading this needle toward a soft landing? Or are you a little skeptical?
I'm a little skeptical because they were late to the party to begin.
And there's still a lot of tightening to move through the system, right?
Exactly. We haven't really seen the full effect. And we do know that inflation is there. We're discounting this part that inflation is coming back to a low number. It's going to be hard to see when wages are already up this high, rent's already up this high, supply chains are all duplicative. We're not, we're deglobalization. So I think there's a fine line there, too, as to how much it's either going to slow down or we're going to have deflation in the system.
That's the thing. You want sort of that beautiful outcome where the inflation rate falls, but the business cycle keeps going.
Right.
And and maybe it'll happen this time. But look at the ISM number this morning. I mean, it's been awful. This is the worst, the longest ISM losing streak.
Right, it was below 50 again.
Yeah, it was like the 15th straight month. Yeah. And it got even worse, and the dispersion of it increased. And so it feels like I can understand those who say, you know what, manufacturing was just in a post-pandemic reset, and it's going to be different this time. Okay, maybe. Yeah. Maybe, but this is not favorable historicals.
So I think the key there is then when you own stocks, know what you own, and just be very careful of valuation, because is it sustainable? Because if you're looking for the Fed to cut, is it going to be for the right reasons?
Right.
So,
yeah, no, that's the $1 trillion question.
Are the sexy stocks like Nvidia going to hold up?
So that's like something we talk about with our clients all the time. So you think about
people ask me. It's like remember 20 years ago, CMGI or whatever these Safeguard Scientific. They were these stocks that didn't do anything or make anything or make any money, certainly.
Well,
but Nvidia makes plenty of money.
20 years ago, Cisco made a lot of money too.
Yeah.
The multiples compressed by 80%.
Yeah.
Nvidia is a great company. It needs to grow. We own it. It's one of our largest positions, but it needs to grow 30% a year for it to sustain its valuation. And that means no competition coming in. That means, people are going to still buy they're going to pay the same prices at the same margins, and demand is going to increase, and no competition comes in. Mm-hmm. Mm-hmm. I think you could own it. You just have to be careful as the size. Sizing is really important, because the
size of your holdings within your portfolio.
Your holdings in your portfolio, because it's a very volatile stock. And if you look back historically, even go back a couple of years, when Nvidia has misstepped, the stock doesn't correct 5 to 10%. It's 20 to 30%. So you need to be prepared, but it can also do that on the upside. But on the upside, it's pretty much baked in. We're expecting 20 to 30% earnings growth on and that is basically, Kelly, to your point, the economy needs to be where it is.